What if the financial disaster you've been bracing for already happened, and you just haven't opened your credit report to check? Right now, everyone's watching the news for the next student loan wage garnishment headline. But while that story sits paused, millions of Americans already watched their credit score drop by as much as 175 points months ago, the second their loan was reported as defaulted. The garnishment pause everyone's relieved about isn't the end of anything. It's the quiet part before the part everyone's actually worried about. My name is Joey, and on this channel, I want to teach you how to save, invest, use, and grow your money so you can have more freedom and retire earlier without depending on the government. Subscribe to the channel and like this video. Here's the timeline, because the headlines have made this confusing on purpose. Student loan payments resumed in 2024 after years of pandemic-era pauses. Millions of borrowers fell behind almost immediately. By the fourth quarter of 2025, roughly 1 million federal borrowers had defaulted. In the first quarter of 2026 alone, another 2.6 million joined them. All told, close to a quarter of the entire federal student loan portfolio is now at risk of default.
Wage garnishment, the part everyone's been dreading, actually started rolling out in early January 2026, then got paused on January 16th with no announced restart date as the Department of Education transitions borrowers into new repayment plans. A lot of people heard paused and mentally filed this under handled. Understandable. It's genuinely good news that the most aggressive collection tool got put on hold before it hit anyone's paycheck. That's also exactly the mistake, because while garnishment sits paused, credit reporting for defaulted loans did not pause. It's active right now. Borrowers who default are seeing their scores hit immediately and severely. And unlike garnishment, there was no 30-day notice, no phase-in, no headline warning most people saw coming. It just showed up on the report, usually the same week the loan was formally transferred to the default resolution group. A default that happened in February has already been sitting on someone's credit file doing damage for months. By the time this video is going out, let's put real numbers on what's already happening. Borrowers with a new delinquency see an average 62-point drop in their credit score. Borrowers who go all the way into full default see an average drop of 91 points. And borrowers who had excellent credit going in, a score of 780 or higher, have seen drops of up to 175 points because there was more room to fall. Run that through a real scenario. Someone with a 780 score, comfortably in the excellent tier, drops 175 points to around 605, solidly in the fair tier. On something like a $400,000 mortgage, moving from the excellent tier to the fair tier can push your rate up by 1.5 to 2 full percentage points, depending on the lender. On that loan size, a 2-point rate increase adds somewhere in the range of $400 to $500 to the monthly payment for as long as that loan exists, unless they refinance later at a better score. Now add collection fees, which are also already active for defaulted balances. Federal rules allow collection charges of up to 25% of the outstanding principal and interest. On a $30,000 balance, that's up to $7,500 tacked on before wage garnishment even resumes. And here's the detail that catches people off guard. Once a loan is assigned to collections, a chunk of every single payment you make goes toward that fee first, not your principal. Pay a collector $200 with a 25% fee attached, and roughly $150 actually reduces what you owe. The other $50 just paid for the privilege of being in default.
And once garnishment does come back, the government can take up to 15% of disposable pay without a court order. On a $70,000 salary, roughly $4,500 a month take-home, that's up to $675 a month gone before it ever reaches a checking account. Run that for even a single year, and it's over $8,000 pulled directly from a paycheck with no negotiation involved. None of that required a single garnishment notice. It's already priced in. Now, you might be thinking, the pause is real, so I have time. Technically true. Psychologically, it's doing more harm than good. This is a classic case of the absence of bad news getting mistaken for good news. Nothing arrived in the mail, so the brain quietly downgrades the threat, even though the credit damage already landed and the collection fees are already stacking. There's also a pure avoidance pattern at play. Checking studentaid.gov, pulling a credit report, opening a collections letter, all of it feels like it will confirm something painful. So a lot of borrowers simply don't look. But the pause isn't a deadline extension on your default status. It's a pause on one specific enforcement tool, not a pause on the clock, not a pause on the fees, and not a pause on the credit damage. Avoiding the number doesn't stop the number from moving. There's a version of this that hits high earners especially hard too. The assumption that a strong income makes this a low priority problem. It doesn't. A defaulted loan doesn't check your salary before it reports to the bureau. And a 175-point drop hits a $150,000 earner with a 780 score exactly as hard as it hits anyone else. Arguably harder, since a Henry is far more likely to be actively shopping for a mortgage or refinancing a car in the near future, which is precisely when this kind of damage gets expensive.
First, log into studentaid.gov today and confirm your actual status, current, delinquent, or defaulted. Don't rely on memory or on whether you've gotten a scary letter yet. Letters have been inconsistent all year. Second, pull your credit report and check that whatever is being reported is accurate. Errors happen constantly during mass servicing transfers like this one, and disputing an error is far easier than undoing months of damage. Third, if you're in default, look into loan rehabilitation. 9 on-time, agreed-upon payments, and the default label comes off your credit report, even though the loan itself doesn't disappear. It's slower than people want, but it's the most direct path back to a normal credit profile. Fourth, don't wait for the garnishment pause to end before you act. It could lift with the same lack of warning it started with. Enrolling in an income-driven plan now, before that happens, is the difference between choosing your payment and having one chosen for you. First, log into studentaid.gov today and confirm your actual status, current, delinquent, or defaulted. Don't rely on memory or on whether you've gotten a scary letter yet. Letters have been inconsistent all year. Fifth, if a mortgage, auto loan, or refinance is anywhere on your radar in the next year or two, treat fixing this as time-sensitive, not optional. A credit score that's already climbing back up by the time you apply is a completely different negotiating position than one that just took the hit the same month you're trying to close. None of these 5 steps require waiting on Washington to announce anything. That's the whole point. The pause controls when the government moves, not when you're allowed to start repairing the damage or protecting yourself from the next round of it. The garnishment pause isn't the story. The credit damage already happening quietly to millions of people is the story. And it's fixable faster the earlier you catch it. Subscribe to the channel. I track policy changes like this one the moment the numbers are verifiable, not just when they trend. If you want the full breakdown of the new repayment plans replacing the SAVE plan, I made a whole video on that. Links above. I'll see you in the next one. Second, pull your credit report and check that whatever's being reported is accurate. Errors happen constantly during mass servicing transfers like this one, and disputing an error is far easier than undoing months of damage. Third, if you're in default, look into loan rehabilitation.